Hello friends, you're watching Tax Dosti videos. Paragraph 9 of the judgment regarding section 7E tax on deemed income says that from pursual of the aforesaid provisions, which means that in the last video, part 8, you're watching part 9, the judge highlighted the important provisions of the section 7E tax on deemed income. That is, if you hold assets in Pakistan, you will have to pay tax on them. It appears that for the tax year 2022 and afterwards, a tax has been imposed at rates specified in division 8C of part 1 of first schedule, and the rate is 20% on the deemed income on the income specified in this section. Subsection 2 of section 7E has further provided that the resident person shall be treated to have derived as income on the amount equal to 5% of the fair market value of the capital assets situated in Pakistan held on the last day of the tax year, excluding one capital asset owned by the resident person, self-owned business premise from where the business is carried out, self-owned agricultural land where agriculture activities carried out by such person, and the capital asset allocated to a shaheed or dependent of shaheed belonging to Pakistan Armed Forces, a person or dependent of the person who dies while in service of Pakistan Armed Forces, or a federal or provincial government, a war wounded person while in service of Pakistan Armed Forces, or federal government or provincial government, and an ex-serviceman and serving personnel of armed forces, or ex-employee or serving personnel of federal and provincial governments, being original allottees of the capital asset duly certified by the allotment authority, any property from which income is chargeable to tax under this ordinance and tax leviable is paid thereof, capital asset in the first tax year of the acquisition where tax under section 236K has been paid, and where the fair market value of capital assets in aggregate, excluding the capital assets mentioned in clause A, B, C, D, E, and F. Basically, the judge had again rewritten the section in a way in his own words, and now is proceeding to explain it. Does not exceed rupees 25 million. Similarly, capital assets have been defined in subsection 4A, because in the previous video, part 8, out of the whole section, section 7E, this part, the resident part, the exclusion part, and now the capital asset, these have been again described by the Honorable Judge, and means property of any kind held by a person, whether or not connected with a business, but doesn't include any stock in trade, consumable stores or raw material, any shares, stocks and security, any property to which a person is entitled to a depreciation deduction under section 22 or amortization under section 24, and any movable asset not mentioned in clause 1, 2 or 3. The argument of the petitioner counsel as noted herein are threefolds: that the impugned level is discriminatory, it is confiscatory, and beyond the legislative components of the federal legislature. We will deal with these one by one in the following manner. So, in paragraph 9, after rewriting the section, now the judge will give his arguments why he thinks the law is not discriminatory or is discriminatory. Similarly, why the law is confiscatory or not, and why it's beyond or not beyond the legislative competence. That is, the legislator had the power to make this tax and apply it on this class of persons. So, in part 10, we will start with discrimination, and in paragraph 10, and if required be, will include जो है okay in every so it's a very well drafted judgment. So in paragraph 10 we will discuss whether the judge will give his reasons whether this law is discriminatory or not. See you in part 10. I hope you are having a good time learning about how judgment is written, what tax laws are, how to challenge tax laws, and how to be a good tax dost. Thank you.